Hi, I'm Bill Bronchick, and in this video we'll explore the Series LLC. This is a relatively new creation, started about 10 years ago in Delaware and now available in about 11 states. This is a device that was tailor-made for the real estate investor who has lots of rental properties. And the way it works is, the Series LLC is like every other LLC in that it has owners, which we call members, and it has, or can have, but usually does have, managers who run the company. And the managers can be the members, or one or more of the members, or some third party. So we have managers, members, we have a company. The company, let's say, goes out and buys a house. And let's say it buys a duplex. And let's say it buys a condo. And it's going to rent these all out and collect all of the income from these properties, pay all the expenses and so forth. And if someone is injured on any one of these properties, they're going to sue the LLC, which protects the members from personal liability. But what it doesn't protect is the properties. So if someone is injured on any one of these properties, they're going to sue the LLC, get a judgment against the LLC, and therefore get anything the LLC owns, to wit all the properties. So what some people will do is break this up a little bit. So they form what we call subsidiary LLCs. So an LLC here, an LLC here, an LLC here. And these three are wholly owned by the master. So the sole member of all three of these LLCs is the master LLC, which has its own members, which could be one, two, or more members. And that way, if someone is injured, let's say there's a house here, and a duplex here, and a condo here. If someone is injured on this property, they could sue this LLC and get a judgment against this LLC, but not the other LLC, so they can't get to the other properties. Now, the only challenge with this approach is it can get expensive if your filing fees are significant in your state for multiple LLCs, especially if you have 12, 15, 20 properties. Also, in order for this to work, you really need separate bank accounts for each LLC to keep the accounting separate, unless you have a property management company that handles that for you. But even still, the money's got to really flow through the LLC bank accounts. So paperwork and cost and efficiency, not very good. What we have with the Series LLCs is the ability to create what are called series, or cells, so to speak. And each series is not an entity. It's just a designation or grouping of business, lines of business, or assets, or particular types of activities that the company engages in. And each cell or series is like an LLC in that it protects the other series from liability as well as the master. So a judgment against Series 2, for example, should not affect Series 1, Series 3, or the main. And the nice part about this is there's no annual filing or creation with the state of the series, with the exception of the state of Illinois. So if you're in Illinois, there's a nominal fee for each series, but in most states, the series don't file anything. So they're created by document. So what you do is you have the main master operating agreement, which gives the authority to create separate series by agreement. So, for example, if you were in a series state, like let's say Texas, Illinois, or Utah, you would form it in that state, the master LLC, and then that registers with the state, has an annual filing fee, has its own tax ID number. And then you have separate series which don't file with the state, don't have the separate tax ID number, and don't have separate tax filing. Everything gets reported on the master LLC's return. Now, in theory, you can have different members and managers for each series, but that creates the same nightmare as the first scenario with now you have to have multiple tax returns, multiple bank accounts, and so forth, so that kind of blows it up. So for all intents and purposes, the way we're going to run this is the series are like little groupings of assets that are like LLCs in that they don't have any liability from one to the other, but they're not separate filing entities with either the state or the feds, with the exception of Illinois, where there is a nominal filing fee. Now, in order to run this, do you need separate bank accounts for each series? No, in theory, no. At least in the state of Delaware, and I like Delaware for filing because it's the oldest statute and it seems to have the most clarity, but it specifically says that the master LLC can take ownership or title to the series assets. So, ergo, we would have a bank account, which I call an FBO, which stands for benefit of. You may have seen those before in a trustee situation or with an IRA, a for benefit account. That way, we have let's say this company is ABC LLC. We would title assets in ABC LLC Series 1, ABC LLC Series 2, and so forth. And then the tenants would all write checks to this one account payable to ABC LLC. And then on the memo line, they write Series 1 or Series 2 and the address of the property. And in your QuickBooks, everything goes into one, almost like a trust account or a property management type account, where you designate by class or memo which series this income or expense comes in or out of. Thus, no need for multiple bank accounts. If you live in a series state, one of the 11 series states, this is a no-brainer, because if you've got 20 properties, it's a whole lot easier to do it this way. If you don't, I live in Colorado, can I use a series? Yes, I do use a series. I formed it in Delaware. I registered the main LLC with the state of Colorado, but not the series, because the series just own real estate, and that is not, quote, doing business, nor does it require a filing with the state. Not that the state would care, because our filing fees are low, but if you went to a state like California, for example, California charges $800 per entity per year, so they're the one state that ruled that each series has to register and pay an $800 minimum franchise fee per series and plus the master entity. So this is not going to work well in California, but in a low tax or low franchise or no franchise tax state, you register the master LLC, and then each series is created to own one or more properties or different classes of properties or assets with one bank account, and theoretically they're all separated for liability. Now, the reason I say theoretically is this is rather new, and there's been no major court decisions on this yet, particularly in a state where the statute does not exist. So if you do this in Texas, where they have a series statute, or in Delaware, where they have a series statute, I think it's a no-brainer. The courts are going to rule exactly what the statute says, that they're separate in liability. But the question is, if I did this, let's say in Florida or Colorado that does not have a series statute, is Colorado court going to look at the Delaware statute that says separate liability, or are they going to make up their own rules? My gut feeling is they're going to do the same analysis, whether it's a series LLC or whether you did subsidiary LLCs, single member. The analysis is the same. It's whether they were really separate. Did you keep separate accounting records, good accounting? Did you rob Peter to pay Paul? Was the conduct being complained of egregious enough for the court to want to pierce through this all and hold the master LLC liable? And again, it's not that you'd be liable. If this failed, then the series fold, and then the master LLC is liable, which is, no worse than if you just used one LLC. So, this is something that you have to make a decision whether you think the courts are going to rule in your favor. If you have 30, 40 properties like I do, to me it was a no-brainer. I keep them separate series. I'm confident that it's going to work if I get into a lawsuit or any kind of problem involving one of the series, because I keep it clean, I keep the documents separate, I keep the accounting separate, and I think it's going to work just fine. But if you can't keep them separate and the accounting separate, then you're better off going the other way, which is multiple sub-LLCs underneath, which is going to mean separate bank accounts, separate accounting anyway. So my thought is, if you keep good records and you do it clean, then this is going to work. If you're not going to be clean with your records or your bank accounts, none of it's going to work, either this or the sub-LLC model. So in my book, there's a trade-off between the potential risk of this not working versus the headache of having 15 or 20 sub-LLCs and 15 or 20 bank accounts. I'm willing to take that risk. I don't think it's a big one. You may not think it's a big one either. Which is worse, having to do 15 bank accounts or having to do one bank account and there's a small chance a court might not rule? Or you may wait until the courts resolve this in a more detailed fashion before you take action. But you should take a good look at the Series LLC. I like it. I use it for myself. Many of my clients use it, and they report that it's simple, it's easy, it's efficient. If you'd like more information on Series LLCs and how to set one up, please contact us at our office at 303-398-7032. Thank you.